Hey team, how are you all?
Hi.
We're here today with Oscar. He's a mortgage broker, and we're going to be asking all the questions that all of our clients have been calling us about and wondering what is going on with this market. So welcome, Oscar. Hi, how are you?
Hey guys, how are you? Great to see you guys all. Miss you guys.
Hi, you too.
So I have a ton of questions just because all of our clients are concerned with what's happening with the market. I mean, there's a lot of headlines in the news, on Facebook, social media, that's just all negative, or, people are reading the articles wrong, or the headlines are just, they're wrong, and it's not what that article actually says, So I have some questions just regarding with, what we're doing right now with the market and how we can help our clients. I know there's the forbearance and the all the deferred payments, and what are their options with the forbearance, and what mortgage companies are actually doing, do you think?
So, and that's the big F word right now, right? Is forbearance. We are seeing it out there. As far as a way out for folks, there's no doubt that there's folks that are in financial duress, and forbearance may be their only option. But what people need to understand, it's not as easy as it may sound. As far as going into forbearance, they do have to go through an approval process with the lender of sort. But people need to understand too that by not making your payments for 6 or 12 months, I believe it's even up to 18 months, but to keep it simple, let's just say 6 months, they're not making their mortgage payment for 6 months. Those 6 months are due payable after those 6 months. So you could do the math. If you got a $3,000 mortgage, it starts to add up after 6 months. So it may put someone in a very tight position. And that's why we're encouraging those folks that maybe have saved up for a rainy day, have that savings. Well, again, this is your rainy day. This is the opportunity to stick to your commitment, make your mortgage payments on time so that it does not affect you in a negative way. Now, you talk about headlines. There's a lot of talk, these forbearances are not going to have a negative effect on people's credit. And they're right. It's not going to have a negative effect, meaning it's not going to affect their credit score. It's not going to show as far as any lights of any sort. But what's also happening as this market is evolving, and a lot of the talks that are happening on the back end with lenders, is how is this going to be treated a year from now or 2 years from now? And I can tell you that what I can see happening, because this is what the talks are about, is that lenders may require some form of seasoning if there has been a forbearance. So let's kind of fast forward to next year, right? If there's someone that goes into a forbearance, doesn't make their payments for the next 6 months, let's just say they do have the money and then they get caught up after the 6 months. That's the idea, right? That forbearance is still going to be reported on their credit. So come next year, if they come to you and say, hey, Jecka, we're ready to sell, we're ready to buy, I've got plenty of equity, and I've got a 720 credit score, which you'd say was ideal, and they have great stable income. Well, the downfall may be that at the time we pull their credit, lenders may treat that and say, well, we now require a 12-month seasoning or a 24-month seasoning from the last reported date of that forbearance. So it's something to think about. That's what we're really getting in people's ears and making sure, like, hey, listen, if you can make the payment, please make the payment. We understand that job security and things like that are a factor. On the upside of things is these PPP loans, right? The first batch of funds that came out were absorbed by the larger companies, which also happen to have the largest amount of employees. Just this week, the small businesses started capitalizing on that. So what I'm letting people know is like, hey, listen, the reason it's payroll protection, the reason these companies are getting this money is so that you continue to get paid. So if you're getting paid and you're at home and getting paid, please make your mortgage payment.
Right. So, I mean, to me, it doesn't make as much sense to do. I mean, obviously make your payment if you can make your payment, but even 3 months, if your mortgage is $3,000, I mean, you're missing your $3,000 payment for 3 months, $9,000. You have to make up $9,000 plus your regular payment.
Right.
It's just, that would seem to be pretty difficult for people to do, just because it's like we have to write out this economy. It's going to take a little bit of time to get out of it. So in order, to have a clean slate, they have to pay this money back. It's not forgiven.
Right.
So is there any other option that they're providing us, any deferred
So you have the forbearance and then you have the deferment. So the forbearance is technically, and I'm going to put it as simple as possible, right? So the forbearance is, okay, so you don't make your payments for an X amount of months, depending on the agreement with your lender. And then it's due payable after those 3 months, 6 months, 12, or I believe, like I said, up to 18. The deferment is basically if you have, let's just say you paid 5 years into a 30-year mortgage and you defer it for 6 months. So all that's doing is the end date to that mortgage is being pushed back.
Okay.
And it's still going to be reported on the credit. Now, ideally, the deferment would be the better option, right? For the same reason you said, Jecka, is like whether it's 3 months or 6, you're talking 9,000, 18,000, right? The money really starts to add up. So that, for me, I would say would be the better option, assuming you can't make your payments. And one of the areas that we haven't seen much talks about is for the most part, most people have their taxes and their insurance, right? What we call a PITI payment. So it's principal, interest, taxes, and insurance. When the payment's not made for 6 months, the borrower is still liable for the property taxes. So let's just say they do the better of the two evils, right? They do the deferment where they push it back. And essentially, come the 6 months, those $9,000, assuming it's a $3,000 mortgage, is not due. That's great, but guess what? Your second half property taxes are going to be due.
Right.
There's no talks or that being waived, so people aren't preparing for that. And of course, your homeowner's insurance is due as well. Fortunately, that's not a large amount, but your property taxes can really add up. So that's something that borrowers need to be aware of what that's going to look like during that deferment or forbearance period.
A question for our people: are they going to need to contact their lender, their mortgage? What's your recommendation for people who can pay that part of their impound, but they're not able to pay the full mortgage? What's your information for them on who they could contact for that?
Great question. It's very simple. Just contact your servicer, whoever your lender is. Typically on your mortgage payment, you'll see a 1-800 number. Be prepared to wait. So be patient in making the call. They're a company as well. So, they have a lot of people working from home. And I'm sure right now everyone's receiving a large volume of calls. And that in itself has had a ripple effect on our industry, just for those actually going through and applying for a new mortgage now, from verifying employments and so on and so forth. So there's been a ripple effect, and that's part of it.
So with the help that the banks are providing, with the forbearance or the deferred payments, it seems like we're not going to have a flood of foreclosures, because really they're not foreclosing on these homeowners due to the coronavirus and all of this. So do you feel that there's going to be more foreclosures, or do you feel that the banks are going to be working this out? Are we expecting some kind of flood of foreclosures here soon?
My personal opinion on that, I think there will be some foreclosures, but we're not going to be inundated. I don't think we're in that market. I think as an industry, we've learned a lot from 2007, 2008, which again, we cannot compare the two, right? But there was some learning that was done in 2007, 2008, if you were in the industry. These lenders understand that, and the consumer needs to understand at any given point, it's never the lender or the bank's best interest to foreclose on the home. So they're always going to be wanting to negotiate one way or the other. So play the offense as a homeowner. If and when you're in that unfortunate situation, call the lender, work something out. They don't want to foreclose. There is a concern of the unknown for lenders as far as what that may look like, because the government is saying, hey, do the forbearance, but they're not being clear as far as what a forbearance means to the consumer. The lender is saying, hey, great, we're willing to work with you, the consumer, but the lender in itself also has to get bailed out, because the bank and the lenders aren't the end all. They have a responsibility to servicers. Now, this has nothing to do whether someone's a broker, a direct lender, a portfolio lender. For the most part, everyone sells off their loans in the secondary market. Now, that in itself, because of that uncertainty, has had a ripple effect on the purchase market, right? People are saying, hey, it's so tough right now to get a loan. There's no doubt there's being some changes. But again, lenders, right, are also being proactive proactive and saying, hey, we want to continue to lend, right?
Mm-hmm.
Rates are still historically low. We want to continue to lend, but they have to minimize their risk. So they want to work with better qualified clients. Now, the clients that may not fit that mold now, that's what we're also encouraging them to do the buyer consultation now, so that we can get them ready as simple as 30 days, 60 days, 90 days down the road, and making the right changes to have them be better prepared to step into home ownership.
So I have a question in regards to this whole unemployment period. So a lot of people are basically, either the husband and the wife or just one person is unemployed. So say they were qualified before this all happened, and then one of them becomes unemployed, say for 3 months. And then they want to go back and start, once she gets her job back, they want to start going for a loan again and trying to look for a house. Does that 3 months of unemployment affect what's happening? Or are the lenders kind of like, okay, we understand what happened. It happened to everybody. You got your job back just because you didn't have income for 3 months. Like, how does that work out?
Wow. Yeah, that's a great question.
Don't even know yet.
Yeah. So that's a great question. So it's not going to have a negative effect on the client. So as long as during that 90-day period that they were not working, again, they made their payments on their credit cards, they made their payment on their rent. If they're homeowners, they made the payments on their mortgage. Nothing was rattled. Essentially, they were able to weather that storm, and they went back to the same line of work, right? Maybe it's not the same employer. As long as it's the same line of work,
okay.
There's different ways of calculating income, but just to keep it simple, if someone's a salary, they're making $80,000 a year, and they go back to an employer and they're paying $70,000, then of course we're going to use the $70,000. Where it may change is, of course, their pay structure, right? If let's just say they went from a salaried position, they were with their previous employer for 4 years, salary, they were laid off for 3 months, and then they went to another job, and it's a sales job, right? Then that's going to be very difficult to calculate that income. From that point forward, they may require 2-year seasoning, because anything that's commission, bonus, overtime, that has a tendency of being averaged within the last 24 months.
So Jecka and Oscar, what do you think that we should be telling our clients now? We have clients who are wanting to buy, clients who are wanting to sell. How do you say the market's looking right now? Interest rates, things like that.
Well, I can tell you from the lending perspective, one, there is no blanket answer to that question. Even though it's a valid question, there is no blanket answer. It goes back to that consultation. This is why we highly encourage folks to, if they want to know, we have to address it specifically to them. One of them, of course, that we touch on is making sure that their job security is there. What line of work are they in? Are they essential employees? Are we talking to a client that was looking to take advantage of, down payment assistance, right? Which we know right now is very challenging in a sense. Or are we dealing with a client that says, hey, I've saved up some money and put 5% down and I've got great credit? I can tell you that if they're well qualified and they took the proper steps to get to that point, people are buying. I said, then it may be a good thing, because they're buying, people are selling. I mean, the numbers are there to support it. And of course, interest rates are still historically low. Because the other side of it is, the fear factor, is playing a role in this. It is, some folks are kind of taking the back seat. So those that have taken the right steps, it's helping out for it not being as competitive, depending on the price point that they're looking into.
And from a real estate perspective, I mean, being in the trenches every day, really riding the roller coaster, you can actually feel what's going on with this market, the ups and downs. And, the inventory is still so low and the interest rates are so low, things are moving. I mean, multiple offers, even though the headlines might say sales are down because there's no inventory. There's not enough to sell. Not the prices aren't down. The prices have stayed the same. If not, they might, they're adjusting a little bit higher, a little bit lower, but they're staying pretty even right now. They're just, these houses are going super fast. It's just low inventory. You price them right. The sellers are going to get top dollar still. They're going to sell quickly. And the buyers, they're getting the benefits of, not having as much competition right now, and then taking advantage of these low rates. So I still think the people who are out there really wanting to look for homes, those are the serious buyers, and they're putting aggressive offers in, and things are moving super quickly. So whatever the headlines are saying about real estate, I mean, it's still booming in San Diego for sure. I mean, it's growing, and I think it's going to continue to grow. We have the best weather. So, you know, we're on the up and up.
Hey, there's no doubt. I agree with you 100%, Jecka. I mean, supply and demand will always be a factor. And San Diego's always been a highly desirable area. And I can tell you just from my personal experience, I'm still getting a lot of folks that are still buying here. I'm in downtown and buying in downtown as a second home.
Yeah.
These are folks from either Florida, getting, believe it or not, even New York, right? Very common is Arizona. Folks in Arizona, business owners in Arizona are buying here as a second home because they see the trend. The reality is, you know, we keep saying interest rates are historically low. The beauty of it that all the indicators right now state that rates are going to maintain historically low. So that goes to, if a client is prepared now, this is still an opportunity. And for those that may not be, let's just say that we're affected, right? Because I'm talking to folks right now that we're working with another realtor, we're working with another lender, and for some reason, with the changes, they didn't take a proactive approach. I'm having those conversations with those folks. And guess what? We're getting them ready. We are going to get them ready in 30 to 60, 90 days, whatever, depending on their situation. And they'll still be able to take advantage of rates of what's happening. So again, it's just a matter of, I've always been a huge advocate of just properly preparing, walking folks through. I mean, there's a reason why, you know, I always say who you work with matters, right? It's important to work with agents that have their pulse on the market and they're active in the market today, like you guys, as well as lenders, right? If it's not me, work with someone who is active and very knowledgeable and is going to be willing to take the time to kind of walk you through this process, because, you know, we have to kind of eliminate the whole microwave mentality and saying like, look, this is a long-term investment, and treat every transaction specific to what it is. You know, I deal with a lot of active military and veterans. VA home loans, right, is a big plus.
None of them are out right now.
Right, and even then, I treat every single transaction completely different, because everyone has a different story. Everyone has a different plan, whether it's their next, 5 to 10 year plan as far as what they're looking at as far as home ownership. And speaking of military, one of the pluses, especially if they're active military, they have a fixed income.
Yeah.
So again, and I speak to those folks. I mean, if you have a fixed income right now, VA is historically low. People buying, 500,000 and under, pricing yesterday was at about 2.75, no points on a 30-year fix.
That's crazy.
The majority of the offers coming in are VA. There are a ton of VA buyers out there right now looking. So
yeah, and it's the only loan that I know of right now that's doing 100% financing.
Wow. Yeah.
One thing I've been telling buyers too is if they were on the fence before, getting pre-qualified now is a good option, because when we do open back up, the inventory is still low. Our buyers are going to be competing against multiple offers. So I've been telling people, get prepared now. If you can make your offer, if you can go out and find a home, now's the time, because you don't have as much competition as when everything does open back up. So I think getting in touch with a lender, getting your lists out there for what homes you do want to go see, get your qualification done. That's what I've been coaching my buyers every day.
Yeah, absolutely. One of the things that we're hearing right now, and I see these Zoom meetings come up as far as like the changes that lenders are making, to the qualifications, without going too deep into it. But they are being, like I said, focusing more on that better qualified client. Where some products may have only required a 640 credit score, it may now be at a 680. Now, there's no doubt that there's lenders out there as a broker that are doing 640 and or under, but I'm not going to encourage a client to go that route if I know that the rate that's going to come with that product is going to be a lot higher. That's what people aren't talking about. VA and FHA, they don't have in their guidelines saying you have to have this type of credit score, right? That's number one. But lenders put an overlay to that. In most cases, it was 640. I can tell you anything under the 640 and under, the interest rate's going to be a little bit higher. So the conversations I have with the client and saying, hey, look, if you're at a 640, then we do an evaluation of their credit. A lot of times just doing a little legwork, and this can take just a few days, we can do what they call a rapid rescore and get their score to 680, right? And again, that's why it's about doing that consultation and looking after the client's best interest, not just selling them a mortgage. Our goal is just to put them in the right mortgage that we know is going to get them the best interest rate, which is of course going to give them the best buying power.
Right. And going to the right people that know this stuff. I mean, these buyers are going to save thousands of dollars because their interest rate is going to be much better. Just, getting that rapid rescore. So, I mean, definitely getting that consultation and figuring out, even if you feel you might not be ready, I think just seeing where you're at exactly, and then getting, working up to where you need to be to get those better rates, and we could do that pretty quickly. So
and a lot of times people don't realize that they can use their 401k funds as part of those reserve requirements. So let's just say you're dealing with the client that was going 100% financing, and getting a home loan, and for any reason the lender for that product was saying you needed 3 months reserves, or heck, even 6, but let's just say it was 3, they can utilize the funds that are in their 401k as reserves. And a lot of times, I've seen lenders make the mistake where they just grab their checking and savings, how much do you have saved, never bother asking if they have a 401k, even though it reflects on their pay stub that they do, right? It just doesn't reflect the amount. They may have $20,000 in reserves right now in those funds, that the client's thought is that's just retirement. They're not really seeing that as savings, but the lender, we treat that as savings, and we typically grab a percentage of that, a large percentage of whatever's in their 401k, and that can put them in a position saying, wow, you fell out of escrow on a product, and this person may work for someone like, say, NASCO, right? Their employee retention is very high. So they may have been there for 20 years. I know if someone works at NASCO, there's a very good chance that they have a 401k, especially if they've been there for a numerous amount of years. Then I know that those are funds that we can utilize. Or if they feel that they're limited and say, hey, I've only been able to save 3%, I'm like, gosh, if we can put you in a better position, you pull money from that 401k and do 5%, put you maybe in a conventional product, here are the benefits of that. Again, all we're simply doing is presenting options to get the client to think on different ways that we're going to put them in a much better position, versus just saying, hey, this is the easiest loan to do, and that's the route you're going to go.
Awesome. Well, thank you, Oscar, so much for answering our questions. We just have, all of our clients that just, they have so many questions and they don't know which direction to go. So, hopefully we can answer these questions a little bit better for them and explain what's going on, and maybe even share this video to them and have those answers for them. So thank you so much for joining our meeting today. We appreciate it.
No,
thank you, Oscar.
Thank you guys for reaching out and always being proactive and making sure that, we stay ahead of the curve as far as what's happening. And I agree, if this is content that you can share with your sphere, your past clients, just to get them in the know, go ahead and do so, and all I can tell you and them and saying, if they're considering buying or selling, they need to start having those conversations with you guys now.
Yes, for sure. Thank you, guys.
Excellent.
Thank you, guys.
Thanks for your time. See you guys.
Bye.